This video covers margin requirements in short selling. We'll discuss the motivation for trading on margin and for short selling, and we'll discuss and calculate the risk and return aspects to trading on margin and short selling. So the first thing we want to ask is, well, what is margin? Well, margin is where you borrow money from your broker to buy a stock. And we're going to be looking in terms of just the stock market here. It's easiest to wrap our heads around the concept of margin requirements and short selling with stocks. You can do these concepts with bonds, but stocks are much easier to understand, and it motivates the ideas better. So a margin requirement allows you to borrow money from your broker. Now here, what's often confusing right up front is margin is not the loan that you get from your broker. Margin is actually the equity in your account, the skin in the game that you put in, the skin that you put into the game. That's margin. Okay. Now the motivation for margin is leverage. You're going to leverage yourself up, and what that means is you're only going to put a small deposit down. Well, I shouldn't say small. You're going to put a fraction of the actual cost of the stock down and give that to your broker, and you're going to borrow the rest. So what that means is the money that you have in your bank account or in your pocket gets leveraged in the sense that you can buy a lot more stock if you end up borrowing money to buy that stock. Okay. Now, when you borrow money from your broker ends up borrowing money from the bank. And so there's a couple of interest rates associated with this, because when you borrow money, there's going to be interest rates. There's opportunity costs of money involved. And so the rate charged to customers is called the margin loan rate. So if you borrow money from a broker, you're going to be charged what's called a margin loan rate. And the rate charged to broker is called a call money rate. And I'll talk a little bit about that later. Okay. Now, the stock that you buy on margin is used as collateral. It's kind of like, you buy a house, you put some money down, that's margin, so to speak, in this concept that I'm talking about, and you borrow money from a bank or a mortgage company, okay? And the house serves as collateral in that transaction. The concept kind of works here too. Okay? Now, but there's more to it in the stock market, and it's a little different. So let's get back to the stock market here and look at the two forms of margin that exist. These ideas won't apply to housing, to the housing market, that's for sure. Okay, so the two forms of margin requirements are, there's an initial margin requirement, and that's the percentage of the total cost that must be paid by the customer. And the minimum is set by the Federal Reserve at 50%. And so as soon as you hear that, you need to ask yourself, wait a second, what's the Federal Reserve doing controlling margin rates in the stock market? The Federal Reserve controls banks and manages banks. How's it managing the stock market? Well, here's what happened. In the late 1920s, we had what's called the Roaring '20s, an economic boom. The stock market skyrocketed. There were no margin requirements back then. In other words, you could borrow money, and you could borrow like 99%, and only so if you had a stock that cost $100, you could borrow $99 and just put $1 down. So if you could do that, imagine how much stock you could buy if you only have to put $1 down and you can borrow the rest. So what happened was, when the stock market crashed in 1929, what happened was people's equity, the margin that they put in, that $1, was lost immediately. So if the stock went from 100 down to 99, you just lost all of your equity in the transaction. And then when it goes even lower, you're negative, and you owe the broker now. Not only do you owe the loan, but you start losing money on top of it, and it becomes a nightmare. And so what happened was, since the brokers borrowed money from banks, so what happened is a lot of customers defaulted on their loans with brokers, and the brokers ended up defaulting on their loans to the bank, and banks ended up holding the bag at the end, and the banks collapsed. Long story short, banks collapsed in part because of the stock market collapse of 1929. So the Federal Reserve imposed margin requirements on the stock market. So the minimum requirement is that you need to put 50% down. So if a stock costs $100, you need to deposit $50 and you can borrow the rest, $50. Now, that's initial margin. That's the initial skin in the game. There's also a concept called maintenance margin, and that occurs when the stock market falls below a specific minimum. Okay? And what maintenance margin is designed to do is this. You buy a stock, you buy it on margin, and what happens if the stock falls in value? Well, the broker is at risk at this point because the collateral has dropped significantly in value, and if you don't pay back your broker is sunk. Is going to incur some big losses. So what the broker is going to do is, if over time the amount of equity you have in your transaction that you borrowed money on, if that equity starts to decline and it declines too much, you're going to get what's called a house call. The broker is going to require that you kick in more money into the transaction, into them. In effect, lowering the loan and increasing your equity in the transaction. That's called maintenance margin. The New York Stock Exchange sets a minimum maintenance margin requirement of 25%. So what we want to do now is we want to go over the concept using a balance sheet of, what does buying on margin actually look like in terms of a balance sheet? What's the formula for calculating margin as the stock drops? Because we need to know that, because there's a point where the stock is going to drop and you're going to get a house call. And what that means in English is your broker is contacting you to kick in more money. They want more money because the collateral has fallen in value. So let's transition over to paper so I can outline this better. So right off, let's get the big picture. Let's look at the balance sheet of what's going on. So here's our balance sheet, here's our assets, here's our liabilities, and here's our equity. And when we buy a stock, we're going to buy an asset, and that's P times Q. And we're just going to call that market value. It's the market value of the stock that we're buying. Okay, that's not so bad. Now we're going to fund that stock with a loan from the broker, and you're going to kick in money from your pocket or from a bank account. That money is called margin. That's your skin in the game, and this is the loan from your broker, just called loan. So now let's go into calculating margin, and we're going to calculate it as a percent, and margin is going to equal your equity divided by the market value here. So it's this on the bottom and it's equity on the top. So that's your equity as relative to the market value, and that's going to equal market value minus loans. Market value minus the loan has to equal equity, right? Divided by market value times 100. And I should multiply this by 100 also. I often forget to do that, but that'll get it in the percent form. So here's your equity right here on the top. So it's market value minus the liabilities. So this formula will come in really handy. You can't get very far looking at margin without knowing this particular formula. Now, let's just jump right into an example and see how it works. So assume you purchase 200 shares of stock for $60 a share with an initial margin requirement of 60%, and maintenance margin is 30%. How much money do you need to pay now? That's initial margin. If you borrow the maximum amount allowed. Well, the margin requirement, the initial margin requirement is 60%. What that means is you have to put 60% down and you can borrow the rest. Now, I'm going to show you how to calculate that using this formula. And if we follow this formula, it'll make it easy when you get into more complicated scenarios. So you can take shortcuts when you do these calculations, but you might get wrapped around the axle if you're trying to do more complicated transactions and events. by taking shortcuts. If you follow this procedure systematically, you'll come up with the right answer. Okay, so this, we're going to call this margin in percent, this formula, little m. We're going to use little m throughout this video. How do we calculate what's going on? Like, what are we doing here? Well, we're buying a stock, right? The market value of the stock is 200 shares times 60. That's $12,000. Okay, that's MV, right? We don't know what the loan is. That's what we're going to need to calculate. And if 12,000 is here, it's got to be here. And that has to equal 60%, because that's what the problem is telling you. Margin, initial margin needs to be 60%, so little m needs to be 60. The market value is 12,000. Let's calculate that loan. Well, when you solve for this loan, L, and by the way, you just do the old, if you divide by 1, it doesn't do anything. So divide by 1, cross multiply, and set them equal. And what I mean by that is multiply this by this, and you'll get 7,200. Set that equal, okay, to this, which is 12,000 minus L. And then L equals 4,800. Now, before we go further, let's make sure our balance sheet works. We have $12,000 in market value. We have a loan for 4,800. And that means for this to balance, we need equity of 7,200. Yep, that's right. 12,000 minus the 48. See, this is 4,800. Gives us 7,200 for equity. Our balance sheet balances. Okay, so far so good. Now, let's go further. Suppose the stock falls to $50 immediately. So we bought it at 60. It now goes to 50 immediately after you buy it. The question is there a house call or a margin call? Which means your broker is going to require right then and there that you pay off some of the loan. In other words, reduce the loan and increase your equity in the transaction. And you have to fall below the maintenance margin specified, which is 30%. So maintenance margin is 30%. Now we have to ask ourselves, when this stock drops from 60 to 50, did it blow by this 30% margin requirement? In other words, do we have less than 30% equity in transaction at this point? Well, let's do the calculation. The market value is 10,000, 50 times 200 shares. The loan hasn't changed. So the loan here just sits there. What happened is this thing just dropped to 10,000, right? And when it dropped to 10,000, the loan's just sitting there. It's not changing. This had to drop, right, to get this to balance. Your market value drops, your equity had to drop. At the moment, the loan stays the same when you do this calculation. So we do the calculation, and it turns out that the little m, the margin that we have in our account, is 52%. That's not below 30%. Okay, so there's no house call. No house call, because we're not below 30% in equity, but we are below initial. Initial was 60%, remember? And so when you're below initial, your account may get restricted. For example, you may not be able to buy more stock on margin. And so you'd have to read the house rules. Again, when you open up a margin account, you're going to have to sign a contract, an agreement, margin agreement. It's got to have a lot of fine print in it. And that fine print basically is written up by lawyers, and it's going to detail, what are the interest rates associated with buying on margin? How does it mechanically work? Who has what rights? And it turns out that the broker has the right to call in the loan at any time from you, and it'll actually say that. They can sell the stock out from under you, pay themselves off the loan balance, and give you the equity after some fees. They have the right to do that because the bank has a call loan to the broker, which means the bank can call in the loan anytime. That's what a call loan is. So if the bank can call the loan in from the broker, where's the broker going to get the money to pay off the loan to the bank? Well, they're going to liquidate your stock, the collateral, for the money that they lent you. So it's kind of like a chain reaction type thing. Let's move on from this. So basically there's no house call. The stock hasn't fallen enough. But now suppose, let's go further. Let's suppose the stock, you bought it at 60 and it drops to $30 a share immediately. Ooh, boy, that hurts. The question is there a margin call under this scenario? Well, the market value is now $6,000. The loan is still 48. Market value 6. That equals 0.20, 20%. Yeah, your margin has dropped down below the 30% maintenance, this guy. And so there is a house call here. The question is, how much? Well, first of all, you need to ask, well, how much do you get this up to? Do you get this up to 50%? Or do you get it back up to 30%? Normally, you get it back up to at least the initial margin. You got to read the house rules to know exactly how much to get it up to. But normally, you got to get it up to at least the initial margin requirement. And so let's just say that we want to get it up to 60% in this example. But you can't write a check for 40%. So if you need to get it up to 60% initial and it's at 20, you can't write a check for 40%, and you fill out the check and it says 40%. Your check needs to be in dollars. That's what your house call is. Broker doesn't care about percent. The question is, how do you calculate this now? Okay, so this is what we're going to do. We need a new loan balance. This old loan balance is not good. It's based on some old numbers. So now you're going to get a house call. You need to reduce this loan because your equity has fallen. So the formula for that is not hard. Take the 6,000 minus what we're going to call a new loan balance, NL, a new loan balance, divided by 6,000. And we're going to say that's got to get back up to initial margin, the 60% initial margin. Calculate the new loan, NL. So cross multiply, set equal, and new loan equals $2,400. Okay. Well, you had an old loan of 48, the maximum new loan. So this is the maximum new loan right here is 24. So you need to pay back $2,400. That's your house call. $2,400 is what you're going to pay your broker. And so what that does is that reduces your loan because your equity's already fallen. So you got to put some more money in, and that'll increase your equity and reduce your loan. And so let's check here. So here's our balance sheet. The market value is 6,000 at this point, right? The new loan is 2,400. We just calculated that NL here. Now this has to be 3,600 to balance, but wait a second. We just don't want to balance it. We can interpret this a little better. So let's look at it carefully. We began with $7,200 in equity. That $7,200. That was the 12,000 minus the 48. That was your equity, 7,200 that we had. Okay, so that we began with equity of 7,200. We had a loss of 6,000. We went from, the stock was originally worth 12 grand, right? Again, stock was originally worth 12 grand. It went to 6,000, so we lost. So, hey, when you lose money in the stock market, you lost equity. So yeah, we lost 6,000 in equity, but then we kicked in $2,400 more from the house call. So we increased equity in this account. And so now we have $3,600 in equity. Everything balances and this reconciles, and we're kind of happy about that. Now what we want to do is let's look at the leveraging effects, because the leveraging effects affects your returns and your risk. And let's draw it out. I think a graph of these concepts will really help you, and it'll help you later on in the course. Let's do an example. As in the earlier example, you purchased 200 shares at $60. Initial margin was 60%. So that's just a reiteration of what we just covered. If the stock increases to $90, so it went from 60 to 90, okay, after you purchase, what is your total return? You put a little T there, or just R for total return. Okay, and then it asks the question I'm going to ask after we do that is, what's the effective annualized return? Okay, if your holding period turns out to be 9 months. So you bought the stock at 60, it went to 90 immediately, right? And it stayed at 90 for the next 9 months. And so we're going to calculate the effective annualized return given that. Okay, so let's start attacking these questions. So we want to look at the return given that we have a loan, or basically leveraged. So you can think of this as leveraged or a loan. Okay? And that's going to equal the market value of what we ended up with minus the market value of what we started with. So, think again, we're starting with this timeline. We're starting at time 0, and then we end up at period 1. And this happens to be a holding period of 9 months. Okay? And then we're going to divide this out by the initial investment. And so that's what our return is going to be. So we now have, by the way, we have 200 shares at $90. That's $18,000. That's our market value here, minus what we paid, 12 grand, divided by, well, what was our initial investment? Was it 12,000? The answer is no. We spent 7,200. That's the equity we put in, 7,200. So notice this denominator is smaller, which means this is going to get larger in this context when you have a gain. And so what we end up with is 0.833, or 83% for a 9-month holding period. Okay, wow, look at that. So compare that against a return where you paid 100% for the stock. You'd have 18,000 at this point, 90 times 200. You'd have a $6,000 capital gain, and you would have paid 12,000 if you didn't buy it on margin, which would have meant without leveraged up, unmargined, so to speak, you would have had a 50% return. Margined up, leveraged, you had an 83% return because you only plunked down 7,200 instead of 12,000. The effective annualized return, I'll just do it for the 83%. You can easily do it for the 50%. So, oops, there's an equal sign there, by the way. Let me write it here. So it's 1 plus the holding period return, 8333, and it's to the 12 over 9. So 12 over 9, that's the fraction of holding periods there are in an entire year. There's a little more than 1 9-month periods in a year. That makes sense. Subtract 1, and we end up with 1.24, or 124%. So basically what we did was we extrapolated out. We made 83% over this period. What would it take to do an entire year? So we just extrapolated it out. We got to 124%. Now, let's graph the concept here. So here's our stock price. This is 0. This is our return on this axis. Let's anchor at 60 because that's where we bought the stock at. Now let's look at when we don't buy the stock on margin. Let me straighten that out for you here. So when we don't buy the stock on margin, we got this line. Okay, and this line has a slope of 1 basically. So if you think of this as, look, if you bought the stock at 60, right, and the stock went nowhere here, you have a zero return. If you go up $1, or let's say, well, let's make it easy. You go up $6, that's 10%, then you're going to have a 10% return, and so on. So you can translate this into dollars or percents, but this is basically, think of this as having a slope of 1, because it's your change in your total return, right, for your change in the stock. And so you can put this in terms of dollars or percent, it's going to be 1. So whenever you buy a stock, you're going to have this slope of 1, right? And when the stock goes up, you make money. When the stock goes down, you're in negative territory down here, because this is positive and this is negative down here. Okay, now let's see what happens at $30. If the stock drops to 30, right, you're going to come down here and you're going to get a 50% loss, right? If the stock goes up to 90, trying to be symmetric here, it's going to be a little messy. This will be plus 50. Okay, now that's when you buy the stock 100%. You buy it all yourself. Now let's look at when you buy on margin. What happens is this line steepens, and it's going to look something like this. Okay, so it swings out this way. So when you buy on margin, the stock stays at 60, you're still going to have a zero gain or loss, right? Which makes sense. You don't really get any leverage effects because you're going to pivot on this point right here. But look what happens. When the stock went to 90, we ended up with an 83% return. So I'm kind of going way up here and come over to here. This would be 83.3%. I'm already off my diagram, all the way up here. Okay? And if the stock goes to 30, right, we would end up all the way down here at minus, you can see that, minus 83.3%. So you can see the magnification that's coming about through the tilting of this, the twisting, pivoting of this line. So what the pivoting of this line is telling you is, look, when the stock changes just a little bit, the return changes dramatically. Think about it. If you bought, the margin requirement was even less, you'd have a steeper line, which means the stock just changes a little bit this way on the x-axis, and you got huge gains and losses. Whereas if you buy the stock here, it's a slope of 1. Now, if you actually put down more than 12,000, somehow for some reason you put down more than 12,000, then you'd be flatter, so you can have changes that on the stock that don't have a big impact on your return because you plunk down a lot of money for that investment. So that's the motivation for margin. There's a double-edged sword here. The double-edged sword is, look at this, you make a ton of return on the upside. So when you borrow and things go your way, you're happy. But if you borrowed and things don't go your way and the stock drops, you're down to the negative 83%, you're not too happy. Now the question becomes, at what price do you get a house call? That's a very common question. At what price are you going to get that house call? You bought the stock at 60. How far does it go before you have to prepare to get a house call, an email, phone call from your broker? Well, we're going to call that price P star. Okay, that's going to be the price we're going to calculate, and this is how we're going to do it. So remember, market value minus loan divided by market value equal little m, right? And we're going to substitute P times Q here, and P times Q. Remember I told you market value is nothing but the price times the number of shares. And then ultimately we want to solve for P. And it's like, oh man, this looks like a nightmare, right? So you cross multiply, divide by 1 here, cross multiply, set them equal. And what you get is M times P times Q equals P times Q minus L. So you multiply this times this. Set the two equal here, and you ultimately want to solve for P. Okay, and so you solve, collect both sides. It's in the notes, the detail, but ultimately, so you just basically solve for P, and P star is the answer here, and that's L, the loan, divided by Q. So that's an interesting number in and of itself. That's the loan per share that you start out with. It's a little hard to wrap your head around it because you don't really think about a loan per share. But that's what that stands for. Loan per share is 1 minus little m. And so let's calculate what P star would be in the example of the stock that we bought at 60. So we had a loan initially at 4,800, and we bought 200 shares. Okay, so there's the top part of the fraction, and it's 1 over m, right? And so m is 30%. This is the maintenance margin. Because remember, you plunk money down based on initial margin, and then do you have enough equity in the future given where the stock has changed? That's maintenance margin. So that's what we're putting in here, the maintenance margin requirement. That calculation turns out to be $34.28. You're going to get a house call at $34.28. Let's check it. So it's always nice to check our work. So we check our work, we plug in 34.28 times 200 minus the 4,800 loan that we got, divided by 34.28 times 200. This is the market values. When the stock drops to 34.28, this is the market value. So this is the M calculation. And when we do that, it's 30%. So that means that when the stock falls to 34.28, our margin is exactly 30%. So the point which that's triggered is a price of $34.28. Let's cover short sales. We basically looked at an example, and what you're used to normally, especially coming from a corporate finance course, is you're used to buying what's called long. You're buying a long. When you buy a stock, it's another name for it is going long. So when you buy, you go long the stock. And here what we're doing is we're shorting the stock. And so it turns out if you sell a stock you don't own, it's called shorting. So you can be long or short the stock market. When you're long the stock market, you're bullish, which is why, at the beginning of these videos, the thumbnail is the bull, and that bull, that's a picture of a bull near Wall Street, about 2 blocks from Wall Street. And so you're bullish when you buy a stock, you're long the stock, you're bullish, all means the same thing. When you sell a stock you don't own, you've shorted it, and you're called a bear. So if you go to Wall Street area, at least a few years back, I don't know if it's there anymore, you go there, there's a bar called the Bull and the Bear. And this is basically Wall Street slang. So what are short sales? A short sale is, like I said, it's you're selling stock you don't own, but that doesn't make any sense when you first hear it. Well, it's a mechanism in our stock market designed for you and people to make money when a stock drops. So when you go long, if all you had was long positions, all you could do is buy stock. You don't buy any stock at all, or you buy stock and you're bullish. But if you want a good liquid market and a lot of activity, you want to be able to have a mechanism for investors who are bearish, who expect the stock market to drop, and they can profit from that. So that's what we're going to look at here. Let's go right into an example of how this works. So we're going to look at a stock. So let's say you short a stock, right? You expect this stock to fall, and you short 100 shares. So it's 100 shares, and the price is right now $100. So you want that stock to plummet, okay? Because when you short sell the stock, you're going to do things in reverse chronological order. We're going to sell the stock first and then buy it back later. Normally you buy then sell, but this case what we're going to do is we're going to borrow the shares, sell them, and then buy them back. This is hard for some people. It may take you a little while before it sinks in and you can wrap your head around it, but it works. Okay, so let me continue the example and I can elaborate. So you're going to short sell this stock is at 100. You think it's high. You expect it to go low. That's why you're shorting it. And so when you short it, you're going to have sales proceeds right? Because you sold it. You better have sales proceeds of $10,000. The cost, right? Well, the cost occurs when you buy it back at a later point in time. So let's say you buy it back 1 month later at $80. Well, you buy it back at 1 month later at $80, your cost is $8,000. So you sold it for 10, then you bought it back later for 8. You just made a capital gain of $2,000. But here's the kicker. There's a dividend associated with this stock, and during the 1 month that you had shorted it, the company paid a dividend. Well, where's that come into play? Well, it's going to reduce your profits, and your profits are going to be $1,800. Now, why is this dividend coming out of your profits? Well, here's what happened. When you short a stock, you don't own it. You have to borrow the shares from your broker. Okay? Now, did you hear what I said? You're borrowing shares. Your loan here is in shares. It's measured in shares. When we just did the margin, you bought long, you borrowed and got a loan measured in dollars. But here, you're borrowing shares of stock. So one way to think about it is, how many shares of stock do you owe? Okay? So when you borrow those shares, your broker can get those shares from generally two different places, one of two different places. One, it could be, you have a big broker, and the broker just takes the shares out of somebody else's account, puts them in your account, and sells them on your behalf. So the broker has to sell this on your behalf. The broker controls the money, because the broker would never take shares out of somebody's account, give them to you, and ask you to sell them and collect the proceeds, because people would just short sell and walk away. The broker would never see them again. So the broker controls the process. What happens is the broker takes the shares out of somebody else's account, gives them to you, and you sell them to a third party. Well, in the meantime, the shares paid a dividend, and those shares are not in that account that you borrowed from. So you need to make that other party whole. And so that's what this $200 is. You're going to pay your broker $200 for the dividend. Your broker is going to put that in the account of the person you borrowed the shares from. Now, like I said, this doesn't make sense to a lot of people. But here's how to make sense of it. Let's say, through an analogy, let's say you have a nice crisp $100 bill. And you look at that $100 bill, you look at the serial number, you take it to the bank, right? And you deposit it. Okay, you deposit it in what? You deposit it into an account. And let's say 1 year later, you want to withdraw that $100. Do you think you're actually going to get that exact $100 bill back? Same serial number? No, obviously not. You don't expect that. What do you think? Do you think the bank's going to hold that $100 bill the whole time, right? No, they're going to lend that money out, right? Lend that money out. And so the money really isn't in your account. You walk out the door, the bank deposits, then lends your money out. And when you come back, they'll make sure that money's in the account. They'll give you your money back when you want your money back. But in the meantime, your money's not in that account, actually. It's lent to some company or to some person to buy a car, to buy a boat, or to expand property, plant, and equipment in a business. Maybe it went for inventory. So my point is that you buy stock, it sits in an account. Your broker may lend it out for a period of time. The person that the shares are missing from, they want to do something with that stock. Your broker will make sure they cover it and they get the shares back into the account. Just like when you come in to pull your money out, you're going to get your money back. Right? They're going to make sure that the money's in the account. So that's generally how things work there. So that's basically shorting in a nutshell. But what we want to do is we want to look at the margin requirements of short selling. Ooh, you didn't think of that, right? Well, yeah, there are margin requirements. So when you short sell a stock, you must keep the proceeds in an account. And remember, I told you the broker takes care of that. So this sales sits in an account, right? And not only that, you need to put in 50%, at least 50% skin in the game on top of that. So your account is going to be the proceeds plus 50% of this, another $5,000 in this example. Okay? So again, let's look at the balance sheet real quick. So you're going to have proceeds, which is P times Q, of $10,000, right? And that's your loan. So your loan is equal to P times Q, right? That's $10,000. Okay, the balance sheet balances. You're going to add a deposit, right, of $5,000, which is 50% of this as the maintenance margin requirement. And that's your equity because that's the money you pull out of some bank account or out of your pocket. So your equity funds that deposit there. You borrow shares and that funds what your account. So this is your account balance right here. So this is account balance. Let's do another example. Suppose you short 100 shares of a stock for $50. The initial margin requirement is 50%. Maintenance is 35%. Oh, there could be a house call. But what's the interesting thing about the house call with short selling is the stock doesn't drop. The stock has to go up for you to get a short, to get a margin call. And that's where it's a little mind-boggling. So let's proceed. The question is, how much money you need to deposit in an account to meet your initial margin requirement, and how much will be in your account? So you're going to have sales proceeds of $5,000. That's $50 times 100. Initial deposit of $2,500. That's 50% of 5,000. You need to have an account balance of $7,500. Notice margin equals equity divided by market value, and your equity in the transaction is your initial deposit, that's your skin in the game, divided by the market value, and that's 50%. Okay, we're making good progress. Now let's look at it from a balance sheet perspective, and the proceeds. It's 5,000. The loan is 5,000. That's P times Q. The initial deposit is 2,500, and that's your equity. It's your margin requirement. So it all balances out, and there's your account balance right here. It matches that number. Let's talk about house calls for shorted stock. As I said a minute ago, the stock has to go up because that's when you lose money. And so here's an important point. When you short sell a stock, you expect it to go down, and that's when you make money. When the stock goes up and it goes against what you thought was going to happen, that means you sold something low and you're actually going to buy it back at a higher price, which means you're going to lose money. So you lose money when you have to buy it at a high price. Okay? So right off the bat, you need to think, okay, I'm going to get a house call. I short sell a stock. The stock goes up. I'm going to get a house call if the stock goes up too far. Okay, and the question is, well, how far? That's another P star calculation. What's the price at which I get a house call when I shorted a stock? Well, let's look at the margin requirement here. M equals account value or balance. I'll call it balance because that's what I've been calling it here. Minus P times Q, that's the loan. This is the loan. Divided by P times Q. So notice the loan and the market value are the same thing when you first short sell. Okay, so that's your equity divided by your market value, just like I did up here. Now, if you solve for P star, flip around, divide this by 1, cross multiply, you will get P star equals account balance or value, right, divided by Q. That's this whole thing divided by the number of shares, right here, and then plus 1 plus M, which is the maintenance margin requirement. So if we continue with the example, your account balance here is $7,500. This side of the balance sheet, $7,500 divided by 100 shares. It's $75, right? Divided by 1 plus 0.35, because in this problem, the maintenance margin was 35% that was given in the problem in the notes, It's 35%. So that means this house call price is going to be $53.56. Okay. So you shorted the stock when it was at 50. You expected it to go down, and that's where you would have made your money. But the stock went up, and you're saying, ouch. And not only that, you're going to get a house call. And if the stock goes above 53.56, you're going to get that house call. So let's check her work. I like to check her work because that shows that you understand it better. So here's the check. We're going to take 7,500 minus, oops, this is 55.56. Okay. And that'll be 55.56 times 100. That's the loan, because the loan is in shares, remember? And 55.56 times 100, and that equals 0.35, the maintenance margin requirement. And one more thing that's a little mind-boggling, and that is what happens if the stock goes up to $60? You're going to get a house call because you went above the 55.56, right? You're going to get a house call. How much? It's in dollars. So here's the calculation. It's going to be, you're going to need a new account balance here. That's what we're going to solve for, because you need to kick more money in here. You're going to need to kick more money into this account. And our loan is $6,000, because the price of the stock now is $60 times 100 shares. That's our loan, and that's got to be over $6,000, and that has to be 50%. So in this particular problem, the maintenance margin requirement, or the initial margin, was 50%, and so we're going to keep 50% in this account. Okay, so let's be clear. Initial margin was 50%, and when you get a house call, you need to bring it back up to 50%. That's what's in the problem. So that's why I set it to 50% here. So now you solve for a new account balance, right? Divide by 1, cross multiply, set an equal, and that new account balance equals $9,000. You probably could have done that without the algebra, because look, you need 50% of 6,000. That needs to be 3,000 on top, so that means the new account balance has to be 9,000, which means, look, you have 7,500 in there now. You need to kick in another 1,500. So your new account balance is equal to 9,000. Your old balance is 7,500. $1,500 is your house call. That's what you need to pony up to give to your broker. Ooh, put that together like that. I'm running my papers, 2 different pieces of paper there. Okay, so there I pieced it together. So your house call is this, $1,500. That will get your account balance to 9,000. This will bring it up to 4,000, and this will come up to 4,000. This will be 6,000. Oh, no. So let's stop here for a second and calculate your equity in transaction. Let me get a different color pen. Everything looks blue here. So let's get this number. So we have 6,000 here. We got 9,000. This has to be 3,000. So this is a beginning balance, right? The beginning balance was 2,500, right? We lost $1,000 because the stock went from 50 to 60, right? From 50 to 60, that's $10 times 100 shares, right? And then we kicked in a house call. We deposited more money of $1,500. I should put the line here, get rid of that line. And what we end up with is $3,000, and it matches. The balance sheet balance is 9,000 here, 9,000 on there. So we have this loan financing 2/3 of the balance sheet. 1/3 is being is financed by equity. So that's it for margin and short selling.